Geopolitical tensions are rattling markets worldwide. Dalal Street gives up last week's gains to end nearly a percentage point lower. Broader markets underperformed the blue chips, with the mid-cap index and the Nifty Bank seeing cuts of nearly 2% this week. On this week's edition of Editors Roundtable, we take stock of the week gone by on Dalal Street. We'll put the spotlight on the many big block deals that we saw, and we'll decode the big rise in crude prices. I am Reema Tendulkar. With me are Prashant, Nimesh and Nigel. And joining us here in the studio, in the newsroom, is Ramesh Mantri, CIO at White Oak Capital AMC. Guys, what a week. And I say this with a very, very heavy heart. With the Air India crash in Ahmedabad and then the geopolitical tensions rising with Israel and Iran.
I mean, I think I was just thinking about it. This Friday, this week, what mattered was actually from a market standpoint. I mean, our hearts go out to the victims, of course, of the crash, as you said, Reema. But this Friday mattered because of what we woke up to, which is Israel, Iran, etc. If you think about the last week also, actually, Monday to Thursday was uneventful, and Friday mattered because of RBI.
Yeah.
And that set the course. It's just that we got that breakout last Friday in a big way. And I think it looked like Monday and Tuesday, perhaps things will keep going. Last 2 days, it just sort of petered out and faltered. And I think the close, we've had a negative weekly close as well, as you said.
1% down.
So maybe after many weeks of basically the market doing very well, we've got a bit of an air pocket in that sense.
So Ramesh, we'll just start with the market construct at these levels, the valuations and the kind of rally that we've seen from April.
Yeah, so one, there were significant concerns on growth slowdown and all the uncertainty during the tariff war. Yeah. Now, clearly both growth with the GDP numbers that have got printed and the fact that now liquidity problems have got sorted, rate cuts have come in. So a lot of the domestic factors have really aligned, really clearly setting a base for growth pickup, GDP growth pickup. And we are now getting used to the tariff issue, right? Slowly we're getting used to it. It's going to stay here. So I think things have really clearly improved on the sentiment side. And we can see that clearly. And that's what markets are responding. There are lesser things to worry about.
But the Middle East tensions, right? They're rising. Tensions have ratcheted up this week.
Yeah, so, if you look at the history of Middle East, right, for, let's say from the 60s onwards, there have been constant fires, right? And it's almost impossible to predict paths geopolitical events take. So hope it's like one of those many small things that happen in Middle East and the fire will subside.
The only thing is, I sometimes wonder whether there is something like too much of, as you said, growth is maybe will pick up, RBI is cutting rates. But, the market is smart, right? It kind of sort of senses all of this. And so in that sense, are we pricing in the best for the year already? Or you think, this...
So normally markets are reasonably ahead of fundamentals. So clearly rate cut expectations were clearly there and that followed. And in fact, the bonds sold off post the rate hikes. So clearly something is getting priced in. I think still I would say the GDP numbers were a surprise, right? The pace at which the growth is picking up. And I think whether this geopolitical crisis or the tariff situation is a good wake-up call to India. That you really have to become Atmanirbhar.
Yeah.
Both on manufacturing, on defense. So, and it's good to have a crisis. In this country, we need regular crisis to get focus back on growth.
So as a house, in your funds, are you all fully invested?
See, actually, our philosophy is to be fully invested.
Oh, yeah.
So.
All right, well, let's just take our viewers through what went on in the week, right? The Nifty, as we said, ended with a mild cut of close to under %. But what's worrying the markets? A few factors are at play. One is the geopolitical tensions. They are back on the table. The other factor, if you look at it, is that there's uncertainty with regard to Trump's tariffs. So yes, there is headway, there is talk, but action has not really been coming about. And India is still waiting by for its turn to get a concrete deal with the United States. So that's what we're waiting by from. And what Nimesh will talk about in just a bit is the supply of paper. A little is okay. You can take a little bit more. But now on a day-to-day basis, you're having, either $500 million, $1 billion, or even more than that. And that supply of paper at some point of time, it worries sentiment. And a lot of smart investors will say, why do I allocate right now? There's so much of supply that's coming in there. Actually, some will be looking forward to the earnings season, but at least that's what will, put a bit of a lid in terms of supply of paper. Otherwise, on a day-to-day basis, we have D-Street chatter, and Nimesh tells us not one, not two, or sometimes all four of them are just block trades. So that's another factor at play. There is some optimism, though, with regard to Fed rate cut action, because the inflation prints for this week itself were a little bit softer. And I was looking at the Fed futures, from around 60%, that's moved towards 70%. They're factoring in a rate cut now in September. And then instead of December, they're factoring another rate cut in October. So we'll have to wait by to see what happens on that front. But I think because, we're in a bit of a range, right? 24,450 on the downside, 25,250 on the upside. So the Nifty is on its range, but you have individual stocks that are in a world of their own. Now, if you're allocating money as of today, what is the top bet you'll have in terms of sectors, if you're looking at? And as you said, you're fully invested. So, what would be your allocation strategy?
So when I look at where fundamentals are aligned and where valuations are aligned, like both the combinations, clearly one of the most attractive sector is the BFSI. Then in India, consumer tends to be very heterogeneous, particularly on the discretionary side. I think with our now level of GDP and the growth of GDP, I think consumer discretionary would do well. So that's a clear opportunity. The thing I'm also very bullish on is a part of the manufacturing value chain, particularly on the complex manufacturing, highly technical, complex manufacturing, where we are seeing a lot of small companies break out in India, where they're hitting critical scales, getting large businesses relative to their scale. That space is where I'm very attracted, bullish about. Another very different part of the market, which I think is very interested and few people understand, is this whole REIT and InvIT space in India, which we believe is underappreciated, very early stages, but there's money to be made there.
Okay, all right. Just on the BFSI part of it, if we can drill a little bit more, you've given us color on the other segments. Discretionary consumption is what you like, is what I told us. Specialized manufacturing as well, and REITs is something that we're looking at. But from the BFSI, could you narrow it down a little bit? What do you like from there?
See, BFSI, you can broadly break up into 4 segments. There's banks, there's NBFCs, there is insurance, and there's capital markets, 4 broad categories. Banks, clearly, the focus is on large private sector banks. That's where the real we see the potential. NBFCs, it's more selective. The real pockets, the most interesting pocket is affordable housing, finance. Gold itself is interesting with how gold is doing. And then very select spaces within the NBFCs. Insurance, we think the sector has seen a lot of regulatory headwind concern, but I think the sector will do well. So more focused on life insurance, because that's a long tail business where brands, long-term customer loyalty matters. And capital markets is again slightly broad space with brokers, wealth management, asset management, and market intermediaries and service providers. Again, capital markets again is a very interesting space, where we more tend to like the intermediaries and the service providers over the, let's say, brokers.
But Ramesh, on the capital market side, if you look at the exchanges,
yes,
everybody's trading at 60, 70, 80 times multiple.
Yes.
Are you comfortable as an investor to buy at such higher multiples, or you feel like this is a growth story, so you're happy to pay higher multiples and still hold on to those stocks?
See, exchanges tend to be quasi-monopoly businesses.
Yeah.
Tend to be 2-player, 1-player markets globally. So it's a very attractive structure. It's a sort of a tax or a toll on the growth of the country, right? So it's a brilliant structure. The thing that concerns me about exchanges in India is 80% of revenues comes through options trade.
Yeah.
That I'm not sure how sustainable it is. It's very unique.
And we could see that in the last 1 week. I think that the option volumes have come down, so that's having an impact. So clearly, you're right. Yeah.
So my concern on exchange is the mix of revenues. I would love to see a large part of revenues coming from cash markets.
Sure. But that should happen. Like with so much of blocks happening, I guess cash volumes are also pick up.
On exchanges, it's just a thought, right? At a very fundamental level, exchanges are like utilities, right?
Yes.
So when you see these companies trade at whatever, billions and tens of billions of dollars of market cap, I just sometimes wonder, well, somebody will wake up and say, these are utilities. You're not supposed to. Are these profit-making machines?
Great observation. But see, unlike a utility, think of your power company that tends to have to deploy large amount of capital, and the returns are capped. Exchanges, while they are, you can make that argument, but they deploy very little capital in the business, and profits are not capped. So that's the very differentiation between a classical utility business where you have to deploy a lot of capital and returns are capped. Your capital deployment is very little and returns are not capped. And that's why they're very lucrative. So by the way, exchanges all over the world tend to trade at premium over their indices.
Yeah. The other point you made, manufacturing, and you were talking about that earlier as well, that specialized manufacturing is what, you're not talking about the textile guys, the shoe guys, or so just what kind of specialized manufacturing are we talking about? Just give us some examples, just to kind of think through.
See, in India, the technical talent on the engineering side, is a large pool of technical talent, and when you compare engineering skill availability in India versus the Western world or even other parts of Asia, we have large amount of technical talent. There are now a lot of companies in India that have been able to marry the technical skill of India into manufacturing, what's called precision manufacturing. Now that's playing out in complex auto ancillaries. It's playing out in aerospace, defense. It's also playing out in industrials. And we've already seen a few IPOs happen in that space. That's a space where now this China plus one is going to play out. All the concerns on tariffs. And these are also not vulnerable to tariffs so much because the value addition is very, very high in these businesses. So these are where Indian companies are breaking out. And you will see a lot of success stories.
Any interesting companies per se?
I can't name companies, but you should look out.
With the disclosure? I mean...
there are companies like, you can just look at the last 2-3 years IPOs, whether it is companies like Azad Engineering, which is on the precision manufacturing. There is Unimec. There are a number of such companies which are getting into very complex spaces.
Niche, but complex in that sense.
Very complex. Typical customers.
High-end engineering.
Typical customers are the top 50 Fortune companies. Your customers are going to be your Boeings, Airbuses, Honeywell, someone like a Keynes Engineering also.
Sure. All right. Since we're talking about, the large trades, Nimesh, let's do a quick revision.
Yeah.
Of what you have been telling us. And there's plenty due next week as well. But till now, tell us all the blocks that have taken.
And also, week, Nigel earlier was saying that 4 out of 4 sometimes chatter is blocks now, right? So it was a bit of a...
So that's okay. In the morning, Reema said, let's go across to the block man. Let's go for it.
Okay, so this week itself, there were blocks worth 25,000 crores. So that should not surprise anybody. I'll start with Monday. Big block, Suzlon, the promoter sold little lower, close to 1.5% stake. There is a large block there, 1,300 crores there is. Despite giving such a strong Q4 and a strong guidance as well, the promoters came out and sold. When Tuesday we saw in Premium Energies, one of the PE investors sold 5.5% stake. They've taken out big money. Wednesday we saw again a couple of block deals where the promoters exited. Marksons Pharma, AB Capital. Again, Wipro, there was an inter-promoter sale, but there was a large block there as well. Asian Paints yesterday was quite interesting, right? It's been in the works for a while now that Reliance will sell. Eventually, it's come that Reliance has sold. And what? SBI Mutual Fund was a single buyer and they bought out the entire 3.5% stake. So that was a large block there. C Infosystem, MapMy India. Again, PhonePe owns a large stake, 18%. They came out and sold nearly 5-6% stake in a large block. So that was a large block. And today we saw the Jubilant promoters selling in all the 3 companies and raising close to 20-200 crores. So across Jubilant Foodworks, Pharmova, again Ingrevia, also large blocks. Nearly 1 crore shares they sold and they raised money. So clearly,
and one block which did not happen.
That did not happen. There are a lot of blocks which are going to happen. So
no, I'm saying today, the Genus block.
Genus block didn't happen. That's largely because of maybe lack of demand, because the environment is...
The number would have swelled. It was a large block, but...
Again, it's a small deal, 650 crores.
But anyways, last week you were saying that a lot of the deals are happening at big discounts. Yeah. Is that the case this time as well? With these...
So it's not about individual names, but if you broadly see, like MapMy India, the peak was 2,700, 2,800. It hit a low of 1,500, and now they sold at almost 1,800 or 1,850. So it's not like, the blocks are happening at a significant premium to the recent highs. So from a mutual fund perspective, maybe the difference is that they're able to buy this, large blocks at a much discount to their recent peaks. Is that a right way to look at, Ramesh?
No, first of all, I hear this thing on blocks. I think you have to first acknowledge this is a coming of age of the Indian economy.
Absolutely, yes.
The fact that we have such large institutional capital available.
Absolutely.
Because it's been a very recent phenomenon, we're all surprised. Because we always get surprised with something new.
Yes.
But just think about, I've seen markets 15 years ago, they were just promoters and retail investors, a very small share of the institutions. Today, institutions have scale. The fact that we have a 27,000 crore SIP book just in mutual fund tells you the scale of capital we have.
Yeah.
So one, we should not, I think, and private equity has become a portion of the capital structure of Indian companies. So they will come to sell. So we should actually acknowledge the fact that the capital structure of Indian companies have changed.
Has changed.
And number two, promoters in India also are now, diversifying, building family offices. That's also happening. So first, I wouldn't worry too much about, what's happening there. Of course, there'll be deals there where investors will do well, which happens, by the way, in every company, whether you buy in market. So I wouldn't worry at all about this. In fact, I would celebrate the fact that we are able to absorb this kind of liquidity in markets without disrupting markets.
Yeah, that's a bullish way of putting it, that the markets are coming of age, showing maturity. And also some of these blocks that take place, family offices get set up and some of that money comes
Back into the market.
back into the equity market as well. So,
But the irony is, if you look at it, Nigel, if you're an owner of a company,
Yeah.
you're selling your own stake,
Yeah.
and then you're going to buy into
another.
somebody else's company where you have a more faith on. So, in a way, it's laughable, but yeah, that's how it is. That's
diversification.
Coming of age, diversification, yeah.
All right, we'll take a quick commercial break here. Have to do that. We'll continue our discussion with Ramesh on the other side. Stay tuned.